Mr. David Stryzewski. David, thanks for coming on. Happy Friday to you. I think it's funny. The first thing I thought of is I bet Trump would have loved to have seen these numbers with Powell today rather than miss them all yesterday. What say you?
Well, no question. I mean, when things are improving in ways that are expecting to the upside and the positive side, that's obviously amazing. And so this is a data-dependent Fed that is ultimately, looking in the rearview mirror. So, I mean, really what we're doing is we're looking at rearview mirror stuff. And President Trump is right to be talking about, the need to really be getting rates down and that Powell needs to, probably be looking at this thing. So, in my opinion, he's waiting for the lag effect to show up. With all these hikes, at some point, we're supposed to really slow down. And that's where the stagflation conversation's coming about, or this new tarifflation that might show up. So it's not showing up in the data right now, but, in my opinion, we're probably going to see the lag effect hit at one time. And that's when Powell's going to be forced to do these cuts. But yeah, otherwise, we're looking at PCE coming down to 2%. I mean, this is what Powell has been saying has been the data-dependent answer that we're supposed to be getting to. The challenge, though, is that he's just stuck between the rock and the hard place. If he cuts, we're going to go back into growth in a very significant way. In fact, that's my opinion of when it's going to happen, and it is going to happen this year and next year for sure in very real ways. But the challenge is right now is that, the average consumer is really struggling. Truflation tells us that inflation is, already at that 2% mark, but we're up about 27% in spending.
Yes.
For consumer, it might not be going up as much, but holy smokes, are they drowning with all that new spending?
And I always bring it, to your point, I bring it back home. I pound this, 27% I still think is low. I think it's higher than that. Let's just say it's 30 between us friends. But I mean, sure. There's no way, and that's why I say it's low. There's no way that you can go into Kroger or whatever your local place is and spend $130 today and get what you used to get for $100 4 years ago. Not happening. No, there's no way. And so that's why I think the number's much larger. And to your point, the outlook, I think, going forward as far as growth, I think looks pretty good. I mean, the hard data has been hanging in there. And now that we've seen a little bit of this tarifflation not actually coming to fruition, we have the specter now of maybe 1 or 2 rate cuts. Whether I think they should happen or not doesn't matter, but we might get 1 or 2. We probably get this big, beautiful bill done at some point in time. And then also, we're probably going to have some more trade deals follow through, right? So there's 3 things right there that make me not want to be underinvested. What say you?
Oh, no question. I mean, this is definitely the beginning of a golden age. You can't do reinvestment back in the United States and not see a boom. I mean, reshoring, friendshoring, these are very real things that will boost the supply side economics. And ultimately, that's what it comes down to, is the supply side of things. And so when we see that new infrastructure spending going into place, when we see M2 pick up right now, Powell's going to be forced to drop rates. The big thing that no one's really talking about is that in 2020 and 21 and 22, we were sitting here at record low interest rates. Oh. Every good CFO ratcheted up tons of debt, and now that stuff is coming to roost right now. So we can't afford to refinance our debts at that high level. So Powell's going to have to cut. There's no way he's going to be able to stay high.
And you know what our interest on that debt is today? It's $3 billion a day. I mean, it's insane. So we have an issue there. I've been talking about debt and deficit all day. I don't want to go down that road. But it just, like I said, it just looks like that road going forward. Maybe the fly in the ointment is our debt and our deficits. Maybe that 10-year yield does get above 5.5, and we start to get a little squeeze. But I'll say this to you, David. I don't know how old you are, but you look a lot younger than me. And I'll say to you that I don't think 5%'s high, right? And I think people are going to get used to 6 and 7% mortgages like I did when I first bought a house. It was 7.75. We weren't thinking that was horrible. Actually, it was a 30-year low at the time. So I think I'm pretty bullish going forward. I try to look for the things that might get us in a little bit of trouble, and I think it's going to be that bond market a little bit, maybe if that 10-year yield. That's what I'm having everybody that we talk to look at. But is there anything else out there that I might be missing?
Well, no, you need to be paying attention to the long end of debt. What's going to happen, though, is if debt starts going up to these really high numbers, people need to remember bonds lose money in 5 different ways. I've said on your show multiple times, I can recall that I thought Moody's is going to get moody and downgrade us. We haven't seen the real impact on that right now, but we've also not seen, the global BRICS conversation ultimately come out. I'm looking at the Japanese carry trade and how that's unfolding, unwinding. I'm looking at a global reset of how trade works. I'm looking at a reset here in our financial system. So I think there's going to be strategic bankruptcies ahead. It's going to be acceptable for companies to say, hey, we're not doing as well here. We're going to let that one go. Or AI just took these jobs out, et cetera. And so anyway, it's going to be an interesting time, but I do believe that we are positioned well for the future. And this is not a time to be underinvested. We just need to be strategically invested. We need to have the right anchors in place prior to the big crashes coming up or the big volatility moments coming up. And that's the concern for those that are boomers.
I'm going to call that efficiently invested is what I'm going to call that. Awesome stuff to have you on. Thank you very much, David. Have a great weekend.